joining us, Sandeep Agarwal, fund manager at Sovilo Investment Managers. Sandeep, thank you very much for joining us. How do you look at the entire IT pack, given the fact that nearly 9.5% run up since 1st of October for the entire index?
Yeah, hi, good afternoon, and thanks for having me on the show. So, I believe that, the reason for why the index has gone up is very tough to call out because there could be multiple things leading to that. There could be, short covering or massive underweight, which people want to uh, increase some weight. All those things could be the cause. But fundamentally, how we see is that, the efforts are going down by 30% in IT software services, and you can't compensate that so quickly. So revenue growth, I think, for at least this year and next year will be substantially lower, and for the whole sector. And if growth is low and there is no possibility of any delta on margins, in fact, even rupee depreciation is seen in a wrong way because it does help EBITDA margin optically, but at the other income level, it hurts, and the PAT level are basically similar. So I think very tough to call out why the index has done well, but we believe that you cannot justify the current multiples and the peg ratios at which the sector is trading. And honestly, I don't see any trigger for growth in the sector for next few quarters from now. Obviously, large cap growing at 4-5% and mid cap growing at 10-12% is possible, but at those growth rate, the peg ratios are between 3 to 5 times, which is very, very expensive for this sector.
Sandeep, how do you look at the quarter two numbers? Because we entered quarter two with a very cautious outlook for IT, but many of the large caps did fairly well. I won't say that they were outperformers, but the mid cap companies like the Persistence and the Coforge also did well there. So the IT as a whole, the entire pack wasn't so bad with respect to earnings in second quarter.
No, absolutely. So, the expectations were very, very low. And because expectations were low, the numbers were looking in line or decent. So, you did not see any accident or any big negative surprise from any of the companies. But we also remember that expectations are what? For the large caps, the growth rate expectations are 0 to 2%, 3% year over year, we are talking. And for mid caps, it was between, 10% to 18-20%. Now the large caps are trading at 20-25 times and the mid caps are trading at 30-35 times. So I think, offering 4-5 times peg ratio to large caps and 3 to 5 times for the mid caps in the all companies is little too much because remember right now the fall in efforts is not showing up in numbers. It generally takes time. As the new deals keeps coming in and the renewals happen, the efforts will continue to fall. And even if you are able to increase a little bit of pricing, I think it will be tough to report a very substantial revenue growth. So I don't see the industry to grow at more than 6-7%. And within that, the large cap, I think 5-6% growth, and the mid cap maybe 10-15%, somewhere between that. And if you keep both of that number in mind, I think it's very tough to make an investment case in any of the categories.
Sandeep, I want to play devil's advocate very desperately, but what I have to do is I have to slip into a very short break. So I'm going to do that. But Sandeep, coming back to you, top line growth may not be something that the IT companies may provide, but what they might provide is margin expansion, which could provide EPS lift. And therefore that growth may just be strong, and PE ratios compared to 5-year averages have compressed significantly. They are trading 20 to 30% lower than the 5-year averages. Doesn't that make a case for buying IT at this point?
So, while you are seeing the 5-year PE ratios, but the point is that the average growth has also come off quite sharply, right? So, post COVID, you saw a year when even TCS has reported 29-25% kind of growth. So, if you and if you take an average of that, today we are at a much lower growth rate. So only seeing PE ratio will not help. I think the growth also should be put in perspective. And while I agree to your view that in this industry now margins are not a big challenge, but growth is. But remember, margins cannot improve because there is a every year you have to give wage hike and there is a nominal inflation on the lease rentals and other cost, airline cost, hotel cost, training cost, and all. So you can't make make a case for a higher earnings growth than revenue growth. It's very tough. Even if you are able to post similar revenue and profit growth, I think it is a great achievement. And from that perspective, as I believe and hold on to my view, it's very tough to make money in this sector. Uh, Maybe there will be this kind of situation where this sector will go up, and we have seen that happening many times in last few months, and then again giving away all the gains when actual number comes. And also remember that the quarter we are in, December, by default is a quarter where there are holidays and manufacturing gets hit hard. And then next quarter you have February where there are less number of days. So there is no way you will get any big positive surprise this or next quarter. As far as the anti-AI trade which people are saying, I think it is not correct to see everything with the same lens. In my view, some of the stocks where the risk of price disruption is very high, like Nvidia, and on which I have already given my view earlier also, that it is insanely valued right now. The P ratio may not be right, because at the 92% market share and peak of profit, you cannot apply P ratios. So I think when it comes down, the whole ecosystem surrounding it will come down. Although that doesn't mean that the top 5 7 stocks in US will also come down in the same way. But yes, there will be some correction there, and when that happens, then you will start listening to some other story where it will be said that Indian IT companies are dependent on those technology companies, and if those stocks have come down, we will also come down. So I don't see that there is a structural positive. We are fundamental people, and fundamentally I will only be positive if there is growth revival or something, which I don't see happening. There is no reason to believe there will be a sharp growth revival or even earnings revival.
Sandeep, if you look at the performance, the order booking for many of the IT companies has been very encouraging. None of this slowdown is reflecting in the kind of order booking that we have seen. In fact, many of the mid and tier companies have seen a better order booking in this quarter. If you're penciling in a slowdown there, we haven't seen that coming in through an order booking here.
So the right way to look at that is the book to bill ratio, because the problem is that only absolute book will not help, absolute order book will not help. And secondly, remember that in IT it is very tough to make any conclusive decision based on order book alone, because the order book is a mix of different kind of deals which could vary in different time horizon, and because of that you will never know how much will be booked in which year. So I think the right way to look at it is what is the volume growth, and we are not seeing volume growth coming in any of the companies. There is growth in, like ER&D companies, some of the ER&D companies, but that growth is also limited to, let's say, mid-teen to high-teen. And for that, if you are going to give 35-40 multiple, it is definitely a risk which we carry. Because remember, there the operating leverage to improve margin is also limited, because the staff costs are very high for the quality of work which is required. And secondly, also there is a normal inflation which is happening, and also wage hike which you have to give. So I don't see strong case where this sector will look attractive right now. Yes, some kind of disruption which increases the effort. And in last 30 years, first time I have become negative on the sector, because I believe that this is the first time when efforts are going down in the sector. Before that, no disruption has caused efforts to go down. Always efforts have gone up. This is the first disruption where efforts have gone down. And our leverage from India, software factory of the world, is efforts. And if efforts are going, the time and material thing itself is going off, then how will you make money? That is a question. It means if they make money and really they see big growth, I will be positively surprised.
Sandeep, last question. How much uh, of of IT, of Indian IT, gets impacted as a result of, say, the Nasdaq moving, say US markets moving, say US policy? And talk to us in earnings terms, because that essentially is the knock which IT will take if at all there are no rate cuts which come through, or if the funding within the AI universe reduces. I wouldn't say dry up. It's unlikely to dry up, but even if there's a pullback with regard to that funding.
So the right way to build a proxy is high tech vertical and the some extent product engineering services. So if you see, give or take, in India, the exposure of these two sectors is between 17-18% total, and if you assume that 70% of that comes from US, so we are talking about 18% into 7%, which is like 12% impact. And I don't see that, that number will be like down 50% or 25%. So while I am negative on the growth and margins, but at the same time, I don't see Nasdaq coming off or the constituents of Nasdaq coming on actually changing the fundamentals also negatively. So the impact is very limited. The point I'm trying to make is that we cannot see good growth, but at the same time, whatever we have, we are easy will be able to easily defend it. So I don't see even downside risk on whatever we are doing. But for that, why should I pay so much high pay ratios?
Okay. All right. Sandeep, thanks so much for joining us, giving us that perspective, and we'll let you go on that note.